Hello, in this lecture we will continue working this problem. We just completed the FIFO section. We're going to move on to the LIFO section. Now the LIFO section is going to go over the same dates. We're going to use the same thing, assuming that we are using a different type of inventory flow. FIFO assuming the first in is the first out, meaning the first ones we purchased are the first ones we sold, as we see here. LIFO is the opposite. We're going to assume that we sold the later items. LIFO can be very frustrating to many people because it's not what you would think the intuitive way of selling inventory would be, as FIFO would be. But remember, both of them are just estimates, meaning that we're here assuming that the first ones we bought are the ones being sold. That's just an assumption. It's an assumption that would make logical sense for the way we would try to sell things, but it is just an assumption. We are going to assume the opposite in LIFO, which seems counterintuitive in terms of the way we would actually sell things. But it's important because it's a good demonstration of the other extreme from FIFO to LIFO, and also it demonstrates the what can happen anytime we're having an estimate. So both of these are estimates, and these are going to show you the differences, the timing differences that result from different estimates that we are going to use, different assumptions that we can then make on estimates. So we'll go through these same activities here. So I'm going to pull this to the side, and we'll take a look once again as of the first transaction, which is March 1st. So I'm in F34, so I'm way down here in F34. I'm going to say 3-1. We're starting off in the same area over here in the ending inventory. So I'm in O34. We're going to say that the beginning balance is still that 100 units. They still cost $50. So we're starting off in the same area, equals the 100 times the 50. So I'm just pointing to those cells, O34 times P34, enter. And then I'm just going to pull that over to the last column as well. That's the only thing we have in this at this time. I'm going to make this large and point out that that number here is now what is on our trial balance for inventory. So that's our beginning point is the same. Then we're going to go to 3-5. At which point we purchased 400 units at $55. So we're going to go in the purchasing column here, just as we did before, and we're going to say we got another 400 units. They cost $55 tab. So notice the price went up because of inflation. We're going to say generally prices go up, equal this times this, 400 times 55 is 22,000. Then that's the purchase. Now we're going to see what happened to our ending inventory. Once again, I want to put everything as of this date. So this date, I want to put all of my inventory here and under, and so we're going to have two layers. We've got this layer, which is still there. I'm going to copy that, right click, copy it. We're going to paste it right here in O35, right click, pasting it numbers only, values only. So we still have that, and then we have this new layer. So I'm going to highlight that, I'm going to right click, I'm going to copy it. I'm going to put that in the new layer, right click, paste it, 1, 2, 3. So now what we have is we have this plus this as of this date. So I'm going to sum that up. So we're going to say this equals the sum. And in terms of dollars, we've got the 5,000 plus the 22 giving us the 27. If we were to look at the journal entry related to us purchasing that, it would be the same journal entry we had before. We're going to say it's the 22,000, and we're going to credit 22,000. So inventory is going to go up with a debit. Liability is going to go up with a credit. If we were to post that over here in Z37, equals the 22,000 debit, enter. And we have inventory goes up to 27. That's where it is over here. That's correct. We're going to go to the payable, assuming that we bought it on account, equals the credit. That's a credit. That's a credit, making the credit go up, putting us back in balance, meaning the assets equal the liabilities and the equity. I'm going to pull this back over and look at the next transaction, which happens on March 9th. So we're going to say I'm going to move to the next line down here. That's where the date's going to go on 3/9. We sold 420 for $85. So we're going to go into the cost of merchandise. That should be cost of merchandise sold. So we're talking about not the sales price, not the $85 in this worksheet. We're talking about the cost. How much did the inventory go down by? And that's either 50 or 55. That's the question. So we sold 420 units. The question is, which ones did we sold? We have 500 of them. Did we sell the ones for $50, or did we sell the ones that cost $55? Assuming LIFO, we actually sold these, which again is counterintuitive. You would think those are the ones that came in late. You would think that I would sell these first and then these. But either way is just an assumption. We're going to assume that we sold the later items first. So what I'm going to do is I'm actually going to highlight the two costs here. I'm going to copy the cost, and I'm going to put that right here, representing the two layers of costs of inventories that we could have sold. And we sold all of these 400 because we sold 420. Therefore, we sold, this whole layer is gone. The layer that was at 55 is going to be gone. So I'm going to say the 400 times 55, that's going to be reduced to 0. Then, of these 100s of the other layer, how much of those are going to go away? Well, we sold 420 minus 400 that got eaten up there. Therefore, we're going to sell another 20 that cost $50. So we have the 20 times the 50 gives us the 1,000. So if we're going to see what is in ending inventory, then of these 100, we sold 20 of them according to this measurement, according to LIFO. Therefore, we could say, well, we had 100 minus 20 tab. That'll take us to the nether cell. They cost $50, and therefore what is left? We have 80 units times $50. All right, and then of these 400 units, we're saying we sold all of those. Again, it's just an assumption, but we're saying that those are the ones that we sold. So of the 400 minus the 400, there's none of those left of the 55 cost items. So we have the 0 times 55 tab, that's 0. Now, as of this date, then, we have the inventory of these two. Therefore, we could sum that up equals the sum of these two. So then if we're going to post this, this is the cost of what we sold. So if we were to post this out, then note that we have the receivable here, and then we have the revenue. Now, this journal entry is not being reflected by this table. This table is representing the cost, not the sales price. So the sales price is given here. They're saying it's 420 units times $85. Nowhere's that $85 here because we're talking about the cost being between 50 and 55 so far. So the revenue is going to be 420 times 85, the sales price. And therefore, we're going to have a receivable if we sold it on account going up and revenue going up with a credit. So if we post that in Z36 equals the debit to receivable, enter, makes the receivable go up. And then we're going to go down to revenue down here. Note that net income is here. So we're going to say revenue equals the 35. It goes up in the credit direction. And so net income is going up to 24,980. Then we can record the other half of that. We also lowered inventory and record the cost of the goods sold. How much did it cost us, that inventory? It cost us the sum of these two. So it cost us $23,000 according to that LIFO method. So if we post this out, then we're going to say the cost equals in cell Z41 equals the cost of goods sold. That's going to bring net income down. So we sold it for $35,700. It cost us $23,000. Therefore, the difference here being $12,700 is the net income. Then we're going to go to inventory. It's going to go down. So I'm going to double click on the inventory and say plus, point to the 23, and that takes it down to 4, which is what is in our ending inventory here. So it looks correct. I'm going to pull this back over and snap it. And I'm going to move to the next line. So I'm on this line here. That's where the date's going to go on 3/18. So on 3/18, we purchased 120 at $60. So we're going to say we purchased another 120 units and they cost us $60. Once again, we have inflation here, or the price went up. So all else equal, price will generally go up. So we're going to say we got another 120 units times 50. These are the same units. Notice this is the same things that we're talking about. We're buying the same pieces of inventory. They're just going up in value. So then, not in value, they're going up in price. And so then we're going to pull that information over into the inventory section here. And once again, I want to put all of our inventory under this date line. So as of this date line, we want to put all of our inventory, and we have these layers now. So we still have this 80 at $50. And I'm just going to keep this other layer even though it's at 0. So I'm going to copy these. And then I'm going to paste them 1, 2, 3 right here. Paste them 1, 2, 3. So there's our layers. Now we have a new layer, this 120 at 60. So I'm going to copy that and paste it 1, 2, 3. So we had this layer at $50, and then we bought some more at 55, and then we bought some more at 60. We have to add all those up as of this date line. under here, the totals, and that will give us our total inventory